All right, want to do a real quick video to maybe deliver a little peace of mind to individuals out there who own fixed annuities or fixed indexed annuities. I just recorded something on why banks fail, unpacking the fractional reserve banking system that we operate with in this country. So I think naturally people just think, well, if banks fail, insurance companies fail too. They're kind of two peas in a pod. Well, insurance companies, in particular fixed insurance companies. Now, we're not talking about variable annuities. Variable annuities are essentially mutual funds wrapped up with an insurance product. There's typically like a mortality expense charge that protects you up to your initial deposit, and there's riders and such. But I want to spend some time talking about fixed annuities and fixed indexed annuities. Fixed annuities are very similar to CDs in that there's a set duration or set holding period, say 3 years, 5 years, 10 years, and you have a guaranteed interest rate associated with it. Now, why people should feel good about owning these types of products right now is because fixed insurance companies are required to operate with what's called a legal reserve system. I spelt that wrong already. Now, the legal reserve system, we all know what the legal reserve system is for the banks, right? FDIC, Federal Deposit Insurance Corporation, they will make you whole. We all know what the legal reserve system is for government treasuries as well. It's called the money printing press. The government will just print more money, which they seem to be doing without abandon right about now. But the insurance companies have a legal reserve system that, in my opinion, is not known about nearly as much as those last two reserve systems that I just talked about. The first tier, because it's a three-tiered system, the first tier in a fixed insurance contracts legal reserve system is what's called dollar for dollar reserves. So with a bank, we all know if you go put your money in a bank, this bank, even the most conservative of banks, is going to go to the Federal Reserve lending window and leverage that money up, typically about 7 to 1. So your $100,000 deposit turns into $700,000, and that $700,000 goes towards home loans and automobile loans and business loans and bonds and what have you. And I did a whole video on this, so I'm not going to go into it, but the bank is going to earn a rate of 5%. So they make 35K on your $100,000 deposit, and all is right in the world so long as everyone's paying their mortgage. But as soon as people start defaulting on car loans and bonds and people start taking money out of the bank, it's bad news. That's why we see so many bank failures. Now, what I'm about to unpack for you is going to be why you see so few insurance company failures. It's very rare. If you look at the list of failed banks on FDIC's website, it is substantially bigger than fixed insurance company issuers. Now, there are P&C insurance company failures and other insurance, auto and home, but we're talking about fixed deposits into fixed annuity, fixed indexed annuity contracts. It's a very rare occurrence. And I would say the biggest reason why is because, unlike a bank who's allowed to lever money up, insurance companies are required by law to keep dollar for dollar reserves. Now, what does that mean? For every dollar you give that insurance company, they're going to get audited and regulated, which is very easy regulation. It's, hey, Bob and Sue gave you $1. Where is it? Well, here it is right here in our general fund, right? So they're going to take that dollar and they're going to put it in their general fund. And the regulators are going to go, all right, show me the dollar. What we look for when we shop insurance companies, naturally, we want to work with A-rated companies that have good ratings, because there's rating agencies out there that audit the general funds and they audit the reserves and things like that to give us a little bit more peace of mind. Although I will say the rating agencies and the analysts have kind of fallen asleep at the wheel several times here in the last couple decades. But let's take a look at a couple companies that you might recognize because they've got like big brand names. Here is Lincoln. Lincoln Financial here. Okay. So you can see it's an A-rated company. Here's all the different rating agencies, A plus with Standards and Poor's. But what I look for, the first thing that I fix my eye on is this number right here, the percentage of general account assets. This is what I call surplus capital. This tells me for every dollar that consumers give this company, they have $1.08 backing it up. Okay. And that $1.08 is in this general fund. And you can see this general fund, 70% of their money is in bonds, only 3.6% is in stocks, 12% is in mortgages, policy loans, cash. You could see, and they even break down the bond quality, right? So 60% of this company's bonds is in the highest quality bond. That's AAA paper, that's government paper. And then the other 38% of it is in higher quality. So that's AA paper, probably high grade muni bonds. And then only 2%, 3% roughly, this little sliver is in stuff that's lower quality bonds. This is also probably where the insurance companies like Lincoln Financial owns the My Philadelphia Eagles football stadium. This is where they do stuff like that with that little sliver. They'll do something a little bit more exotic with small chunks of their portfolio, like buy football stadiums and buy football teams and things like that. Um, so, okay, let's look at this one. This is Pac Life. You see the whales jumping through the air. They have 11%. So for every dollar you put in Pac Life, they have reserves of $1.11. And of course, this general fund is managed incredibly conservatively. Like the one I just showed you, it was 60% bonds, um, and 12% mortgages, and the rest of this is some stock and cash and policy loans. And what this is telling us is that their 5-year investment yields on their general fund for this company, Pac Life, is 4.45%. For Lincoln, it's 4.29%. Now, what do they do with that 4.29%? We're talking about fixed insurance contracts here, right? So they take this 4.29% or 4. I'm just going to say 4.5%, right? And some of this goes towards the house, right? So some of this goes towards paying for the building that they operate out of, their employees, the financial advisor's compensation. Some companies use this to advertise, and market companies use this to sponsor the NCAA tournament. And then the other chunk of it goes towards the consumer or the customer, right? So maybe 1.5 of it goes towards the house, and then the consumer buys a 5-year fixed annuity paying 3%. Okay. Now, your job as a potential customer of these companies is one, make sure they got surplus capital because that's important, right? I want to work with companies that have got nice, big, rock solid reserves, and then make sure that they're managing their fund properly. But more importantly, make sure that you're getting a good rate. Make sure you're getting the best deal on the open marketplace, because what I see from my vantage point in this industry, some people or some companies spend a little bit too much of their capital on commissions and golden parachutes for their executives, and they advertise too much, and they give too much to the house and not enough to the customer. It's all about finding a good balance there. Now, let's get back to how these companies make money and why you should feel good about owning them. Now, if for some reason their general fund is awfully managed and a bunch of these bonds default and the stock prices in their portfolio go down and all the mortgages default as well, if for some reason this company only has 95 cents for every dollar of deposits, all of these companies are backed by, they'll either have a parent company or a reinsurance company. Warren Buffett owns one of the largest reinsurance companies in this country. Now, don't quote me on this, but you're going to, because I'm doing this on YouTube. Sorry about this, pen's acting up a little bit. To my understanding, the last I checked, and this is going back to we're going back to the insurance industry in this country is older than the capital market industry, right? Like people have been selling insurance, certainly property and casualty insurance in this country long that they've been buying stocks. So this is going back, let's go back to the Great Depression. To my understanding, there's only been about 14 instances where a insurance company mismanaged their dollar for dollar reserves, and so many of their bonds went belly up to the point where a parent company or a reinsurance company had to bail out the insurance company. And the reason it's so rare is because these general funds are watched like hawks. They're audited, and it's very easy to audit them. It's very difficult to audit a bank's balance sheet because of all of the individual loans that they have out there. When you're dealing with an insurance company, you look at their general fund, it's one bucket of money. It's like auditing a single portfolio. All right, what do you got in here? And all of the bonds have ratings. And when 60% of the portfolio is in government paper, well, you don't even need to audit the 60%. You're only looking at the 40%. So you've got the legal reserve system, dollar for dollar reserves. This gives me more comfort than anything else. The fact that my company, for every dollar I give them, it's sitting in the coffers of their company. But if that goes south, they're backed up by a parent or a reinsurance. And then number three, what a lot of people, feel good about, but truthfully, like you do not want to be here. If your company mismanages their reserves and the reinsurance, like you're getting a bunch of ugly letters from your insurance company and you're not sleeping well at night. And the whole purpose of owning a fixed annuity is so you can sleep well at night. But anyways, I have to shine a light on it. In order to do business in each and every state, in order to be a licensed agent in each and every state, in order for your company to release new products in each and every state, all insurance contracts and companies and agents are monitored and pay into what are called state guarantee funds. And again, just purely from my memory, I only know of 4 instances where an insurance company had to be made whole via a state guarantee fund. I went to a website here. Here it is. This shines a light on the different state guarantee funds that are out there. Okay, so I'm here in South Carolina, and you can see consumers are protected by the state of South Carolina's guarantee fund up to $300,000 per company. Okay, so even if the insurance company mismanaged their reserves and then the reinsurance company was deemed to be insolvent, then the state guarantee fund comes in and you want to check on your state. And I wouldn't trust this company. I just went to a website. I would go directly to your state's guarantee fund by Googling insurance company state guarantee fund limits. So you can see in, New Jersey, it's only $100,000 for annuities, but it's $500,000 for death benefit on life insurance. And it's $100,000 for cash value of life insurance policies. They've got the phone numbers right there that you can call. Okay. So, because of this legal reserve system, but because of the 3 layers to it, people feel or should feel very comfortable with money deposited in fixed insurance contracts. Now, here's the other thing. Because some people are going, well, Adam, the banks are going belly up left and right, and it's because of bonds. They're selling bonds at losses, and then the depositors are left holding the bag. You just told me that the insurance companies own a lot of bonds, and those bonds are down in value because interest rates went up. You are absolutely right. Most of these insurance companies have unrealized losses on their bond portfolios because interest rates went up. Now, unlike banks, however, insurance companies have surrender charges. They have two things protecting them from interest rate risk: surrender charges, which I know when you buy one of these things, like you hate it. You're like, oh no, a surrender charge. I don't want to lock up my money. Well, when there's a banking crisis happening, you should pat yourself on the back going, it's a good thing I have these surrender charges, because these surrender charges are protecting me and all of the other consumers who own these things from interest rate risk. If you buy a 10-year fixed indexed annuity and you're 2 years into it and go, give me all my money back, they might hit you on the wrist with an 8% surrender penalty. Even if you were to buy a 3-year fixed annuity, year one, the penalty to get out of that thing is like 9%. And the other thing that they have is what are called market value adjustments. Not all annuities have market value adjustments, but some of them will. And this is just another protection mechanism that the insurance companies put in place to make sure that their depositors will be made whole and the company is operating in a financially prudent way. All this means is, remember that interest rate risk we were talking about? So bonds have a you know a, an opposite correlation to interest rates, right? So as I rates go up, I rate go up. Excuse me here. I don't know what I did. Yeah, whatever. Somehow drew a square. As interest rates go up, bond prices go down. Well, what a market value adjustment is it's simply, hey, this interest rate risk is something that we're worried about as a institution that owns a lot of bonds. We're going to pass a little of this back onto our consumer. So you could look at it two ways. As the consumer, you go, hey, what the heck? I want the insurance company to take all the risk. But right about now, when the world is going crazy and the banks in our community that we hold near and dear are on bankruptcy's doorstep, you should know, as an individual who owns a fixed annuity or fixed indexed annuity, you have this legal reserve system backing up your deposits, and those surrender charges are actually protecting you, and that market value adjustment is protecting you. And there's whimsical people out there who want to buy something today and then get out of it the next day, and they're going to be the ones punished, not you, as the person who put their money into something and you put it in there to give you a little sleep well at night insurance, so your principal was protected, and if the market goes down, you don't have to suffer any losses. You're the person benefiting from surrender penalties and market value adjustments, and you should feel good about the business decision that you made because of this legal reserve system. Hopefully this was helpful. If you have any questions, please reply to this video or reach out to our office. We'd be happy to talk you through the situation.